Right, well, welcome back to Inside Options. Joining me as usual is James Boardman from the Equity Derivatives Division. James, we were talking about dynamic hedging in terms of delta.
Exactly. Now, we said that the biggest headache for option writers is gamma, where you've got that sudden swing in delta and you need to buy or sell shares frantically, especially at an example like closeout, where you're sort of worrying, do you need 100,000 shares or do you need 0 shares? Switching between the two, very expensive.
So it sounds like you're having to pay a lot of attention all of the time, and it can be quite a scary sort of experience.
But the main compensation to option writers is a thing called theta. Now, as an option buyer, you also have to watch your theta quite closely. So we've got a lovely picture up here of an hourglass. So the sand is trickling through. Just like that hourglass, an option is a depreciating asset. So if either option, a put or a call, it expires worthless, no shares will change hands, and it becomes totally worthless. It just disappears and ceases to exist. So because of this, an option is a depreciating asset, and it decays each day a little bit more and more and more. Now, the interesting thing is the steady erosion of purchased options. We call that theta, or time decay. We call it theta because that's the symbol for theta that we use in the mathematical formulas when we're working with it. Now, that time decay, it always helps the seller of an option, just about always hurts the buyer of an option. So you've got to keep track of the time decay of your options, because that's the time left in the game. Is there enough time that a surprise result can be found to swing the result your team's way? So an interesting property of it is that it doesn't decay in a linear fashion, and it happens all the time. Even on weekends, option writers are making money. They're the only guys on the market who are making money. But time passes, and their options are decaying in value, and they're making money over the weekend. So that's quite a fantastic sort of image. That's why they end up taking those risks, because just every day they've got that steady trickle of theta.
So you can walk into the office on a Monday
morning. Walk into
morning
the office on Monday, surprise profits, hooray. Right. So that's your theta. Now, this is a payoff diagram that shows us, we can see it's a call. So there's that important point, which is that point over there, point A. That's our strike price. Now, the green line at the top, that's when we bought the option. Gradually, as time passes, it's going to decay down to that purple line, and then down to the darker green line at the bottom, where it's got that right angle. That's the payoff at expiry. So we can see that over time, it's going to converge down to just have its intrinsic value. So an option's got two kinds of value at any time. It's got intrinsic value, and it's got time value. Now, the time value is how much better can it get in the future. The intrinsic value is how far is it from the strike price. So 40 Rand put at 35 Rand stock price, you're 5 Rand in the money already. You can close out that position and take that 5 Rand out. The extra value, if the option was trading at 8 Rand, what's that 3 Rand for? That 3 Rand is that time value above that line there. And that is important to know, that value above that, that's your time value that's decaying and moving with your option position. So it's interesting that theta, it doesn't decay in a linear fashion. A futures interest decays at a straight 45-degree line. It just goes right down like that. This is an exponential graph. And it goes like that. Because if you think about it, it's sort of like time passing as you get older. 1 year at 40 is 1/40th of your life. 1 year at 5 years old is 1/5 of your life. So it's a much bigger deal. With an option, it's the same thing. Your odds are getting progressively faster. So here's normal time decay. There are a few funny cases where it doesn't look like that, but for an option that's roundabout at the money, this is what happens. It decays over time as time passes, and you can see it accelerates. It just gets faster and faster towards the end, till on your sort of last day it has this total big fall down to just its intrinsic value. So that's something you have to watch. You've got to see that, are my profits moving faster than my option is decaying in value? And
it's so important to that premium you're paying as well, isn't it?
The premium you pay, the higher the premium you pay, the faster it can time decay. And that's something, how is a premium assessed as high? How is it assessed as low? That's something we're going to look at next week. So you can see this, boom, time decay. So it's that depreciating asset, and you want to keep a close eye. How much time is there left in it? And how are the odds progressing in favor of my team? So those are the two things you're going to be looking at mainly as an option buyer. You've got to measure your risks so you can manage your risks.
All right, great. James, just a note to the viewers, if they want to know more detail on delta, gamma, theta, you can go to the website, JSE's website.
JSE's
check
website.
It out. You've got more information there, haven't you?
There's a lot of stuff there. jsc.co.za/options. Got a lot of quite interesting stuff on that there.
Great. And then next week?
Next week, we're looking at mainly volatility, which is, how do we say, is an option cheap? Is it expensive? What do we compare that to? How do we find out? Are we getting a good deal? That's what we're going to look at next week.
Super. Stay tuned for next week. That's Inside Options for this one. Thanks. Goodbye.
Inside Options was brought to you by the Johannesburg Stock Exchange. Manage your risks with Safex style options.